Traders, welcome back to part 2 of a 4-part series on short put selling. Today's lesson will be about choosing a good stock. We're going to be also going over choosing a good strike and how to do that. And also we'll talk about the best time expiration to sell contracts on. By the way, I combined all these teachings that I learned from a put selling seminar 10 years ago and that I paid $5,000 to learn into one ebook. You can download it at the link in the description below. Let's start. How do we choose a good stock? This is the most important part of selling puts. You need to be only choosing stocks that you're okay with owning in the case that you get assigned. What assignment means is you have to buy the stock, okay? So I repeat, you may have to own the stock, so it better be a good stock. What is a good stock? Usually good stocks are in the SP 500, the Dow Jones, or the Qs. So big cap stocks, big companies. I'll give you some examples like Home Depot, Walmart, Google, Apple, Bank of America, or even ETFs such as XLV, XLF, the financial sector ETFs that contains many different financial stocks, bank stocks that are legit, okay? Another important factor to consider is we needed to have high liquidity. Why do we need high liquidity, you ask? It is because we need volume. We need tight option bid-ask spreads. Because if you have a wide bid-ask spread, you will get bad fills and the slippage will cost you a lot of money. Any high liquidity stock will have tighter bid-ask option spreads. Let me go over what and how you can tell if a stock or ETF has high liquidity. So here I have Tasty Trade open. I'm going to show you how we can check the liquidity of a stock or ETF or any instrument. If you go to your watch list and go to the gear icon, if you click on it, there's something called liquidity rating. Add that to your display list and you will see a bunch of stars over here. 4 stars is the max. So we will be only trading instruments that have 4 stars of liquidity. Even the ones with 3 stars, in my experience, are so-so, especially for option contracts. So only look for the full stars ones. For example, JETS right here, this ETF has 4 stars. SPY is 4 stars. SLV Silver is 4 stars. So these are very nice ETFs to be trading options on. Another factor we need to look at is the IV rank. IV rank, you can find it right here. For SLV, right now it's 57. You can also add it to your watch list under the gear. It's called IV percentage, IV rank percentage. How I do it myself is I sort it by order from highest to lowest because I don't look at stuff that are below 30 in general. Right now, we can see there's a lot of high IVR percentage numbers because right now the market is very volatile. So there's a lot of good candidates to trade. Okay. Let's move on. Oh, by the way, the most important part is you need to be bullish on this stock or instrument. This strategy, I repeat, is a bullish strategy. I know in the last part, in part 1, I said you can still make money if the instrument doesn't move or even goes down a bit. While that's true, in general, we want to be only opening short puts on bullish instruments. So you need to have your own style of technical analysis. I'm not going to be going over what is a good stock to go long on. That's outside the scope of this lesson. That will be in another video. But some ideas would be to use RSI, MACD, support and resistance zones. Okay, as long as you believe the stock is going to be going up, then we can open some short puts on it. The next thing I want to talk about is how do we choose a good strike? What is a good strike? So we're going to be using deltas to choose a good strike. In general, anything that has low delta has a high win rate. And when you have a very high win rate, obviously the money you make should be lower. Now, on the flip side, if we choose something with very high delta, you'll make a lot of money, lots of premiums, but you'll have a lower win rate. So, what's a good strike? For beginners, I recommend you guys to start with 20 delta. I think that's the sweet spot between the amount of premiums collected and the risk you're taking on. Now, advanced traders can go for 20 to 30 delta. That depends on your experience and your technical analysis, but that's a fairly good range to go with. Now, choosing deltas is when you want to only collect premiums and then exit and not get assignment. If you want to buy the stock at a discount, as I mentioned in part 1, you choose the price, the strike that you want to buy the stock at. So for example, the stock is at $100 right now. You will choose the strike that you want to buy it at. Now don't tell me $10, okay? Because first of all, you will get no premiums for selling short puts at $10 when the stock is at 100. And second, I'm not sure you want to own it if it drops down to 10. That's a 90% drop. This stock is in huge trouble. So we got to choose realistic strikes. So perhaps maybe you want to buy at $90. You know, a 10% drop, that's reasonable. That's a good price, so you will choose the 90 strike. So to recap, if you want to own the stock, then you choose the strike you want to buy the stock at. If you don't want to own the stock, then for beginners, start with 20 delta. Oh, another important piece is the premiums collected should be 1% for every 30 days to expiry. Let me show you what I mean by that. So, say you open a contract that's 30 DTE, 30 days left, and the price of the strike, and the strike is 100. The amount of premium you collect should be 1.0, $100. Why? Because 1% of the strike is $1. Okay? So if it's $200, if the strike is 200, then you want to collect at least 2.0 per short put contract. That's for every 30 days. So if it's 60 days, okay, what would it be? If we're looking at 60 days. So if we're looking at 60 days and the strike is 100, we're looking at $2 here. Right. Let's erase this. 60 days out, 100 strike, you should collect at least $2. Now that we explained what is a good strike to choose, let's move on and talk about what is a good expiration. 30 to 60 days is good. Okay, you want something in between those two ranges. 45 is perfect, the sweet spot. But we don't always get that. So let's look at this example. Oh, by the way, we only want to be looking at monthly options. What does that mean? If you look at my picture right here, all these stuff with W's, those are weekly contracts. The liquidity on those contracts are lower than monthly. Monthly doesn't have anything. Okay, going on them. So we have a 23-day monthly and we have a 51-day monthly. As per our rule, we only sell on 30 to 60 days DTE contracts. So 51 days, May 15, this would be our ideal candidate. We will be doing something with the 51 days. So let's go through some live examples now. Say this is jets. This is the ETF for the various airlines. I'm not saying this is a good long. This is purely an example. Do not go long on this. I'm not going long on this. For example, you say, okay, it is bouncing here and bouncing here. We hit a support. This looks like a good long. The RSI, we just we were oversold and now we're creeping back up to the middle line. IVR is elevated, you think it's good. So you believe that the stock should continue to go back up now. This hits multiple criterias, what we consider a good candidate. So let's go and open this trade. Let's open up Tasty Trade again and let's go to Jets. Jets right now, IV rank is 69. I like that. That's very high. We're gonna look for our 30 to 60 day monthly contract. We only have one choice, which is the 51-day May 15 contract. Let's open that up. I'm gonna look for the 20 delta right here. The 20 delta strike, which is 22. Delta is here, 20. Right now, market is closed right now, so the bid-ask spread is not that good. You can see it's 55 and the ask is 93. So normally if you see this, take your money and run. You're not supposed to trade anything with this big of a spread. However, during the market hours, I noticed it was around 4-cent spread. It was around 70 to 74 cents bid ask. So it was more reasonable then. So just click on it, sell, make sure it's S and it's red. You can see your probability of winning is 78%. That's similar to delta. So a trick for you guys, and I'll talk about it later. 20 delta usually means 20% losing rate. You can use that as a general guideline. Okay. So if you want to open this trade short put to collect premiums only, we will do the 20 delta. And for example, you want to own the stock at 21, then you would go to the 21 strike and open the short put there. And you will hold it until you get assigned. All right, traders, I hope you enjoyed this lesson. If you have any questions, post them below and I'll try to reply to them as soon as possible. Traders, trade small, trade safe, and look out for part 3.